Hi, everyone. Thanks for joining us for today's webinar. During the presentation, please feel free to submit your questions you have at any time in the questions box next to the slides. I'm going to pass it off to Wayne now, who will kick things off for us.
Thank you, Caitlin. Hi, I'm Wayne Lee, CEO of Lee Enterprises Consulting, and on behalf of our 65-plus Lee Enterprise Consulting team, I'd like to welcome you to another of our webinars, Financing Bioenergy and Biofuels Projects. I think we have an exciting group of speakers lined up for you, which I'll introduce shortly. Before I do that and introduce your host for the day, I'd like to give you a brief overview of our services and introduce a few of our key people. As you can see, let me switch slides. As you can see, we have a list of many services that we provide at Lee Enterprises Consulting. As many of you know, Lee Enterprises is the world's largest biomass and biofuels consulting group. There's really, truthfully, not much we don't do between our consultants and our strategic alliances. We are truly a one-stop shop for these types of projects, so please feel free to give us a call with any questions that you have. Today we're going to be hearing from Tim Hoy, who is the head of our biomass section. We'll be hearing from David Edwards of Zeton, and we'll be hearing from attorney Jim Rathall, and then it'll be wrapped up by the head of our business and financial section, Jeff Kistner, who will also serve as your host for today. So before we get into it and I turn it over to Jeff, let me introduce a couple of key people that I hope are on the phone. First is my executive vice president, Dr. Gerald Kootenai. Gerald heads up our two of our sections and is my right hand in the group. He has a PhD in chemistry and many years of experience and many articles. Gerald, would you like to say hi to the group for a moment?
Sure. Hi everybody. I think today's webinar will be especially useful for the entrepreneurs and new technology developers that are always looking for funds. What we found is that they often don't know all the prep work that's mandatory before you have any chance. And we hope that after today's webinar, you'll know the process to have a better chance of succeeding in your financial ventures in the future. Back to you, Wayne.
Okay, thank you, Jerry. The next person I would like to introduce is Ashley Main. She is our Director of Marketing and Business Development and the beauty in our firm. She is our right hand here at the home office. So, Ashley, is there anything you'd like to say?
Nothing really other than just if y'all need anything, feel free to contact me through email or give me a call at any time. Thank you.
All right. Thank you, Ashley. And now I will move to our host for today, Jeff Kistner, who is the president and owner of Flagleaf Financial Management. You can see Jeff's credentials. Jeff is the head of our business and financial section here at Lee Enterprises. And with that, Jeff, I'm going to turn it over to you.
Thank you, Wayne. Welcome everybody to today's webinar. With the expectations of learning and understanding financing for some of these projects, hopefully we can give you some nuggets of information that is useful, and you can hopefully be better prepared as you seek capital sources. With that, the first speaker is Tim Hoy, our advisory director for the Biomass Group for Lee Enterprises, and I'm just going to turn it right over to Tim, and he can share with you his topics and a little more about his background. Go ahead, Tim.
Thanks very much, Jeff, and hello to everyone on the call. Thanks for the opportunity to present today. I'm the president of Clean Energy Consulting and the head of the Biomass Power Group for Lee Enterprises. and we're talking today specifically about biomass power project financing. Just wanted to say that there's a fair amount of detail in the slides, so I'm going to be going fairly quickly just in the constraints of time. So if there's anything that we skip over, feel free to follow up with us after the webinar is over. Our background is in industrial projects and mostly talking about projects in Canada, although with the Lee Enterprises Group, obviously there's extensive experience throughout the world in the U.S. Quite happy to have recently joined Lee Enterprises, our first webinar. So just a couple more slides here. So we do a full suite of project services that are for developers or owners, help them take their project from concept to completion. Okay, get started here on the subject matter. So the first slide highlights a number of biomass projects at varying technologies. These are indicative numbers, so obviously they will be specific to each project and vary by location. But a couple of things that are important to highlight. One is it's really important to get the right, all the right aspects of the project nailed down prior to trying to secure financing. There will be some financing that will need to be done before the full project to enable this work to be done. And the steam is a more traditional technology used for biomass power. It's one that the lenders are more comfortable with. Although gasification and ORC, which stands for Organic Rankine Cycle, which is a thermal fluid with a turbine, are gaining popularity because you can implement them economically at a smaller scale, and their efficiencies are, their heat rates are approaching that of the steam process. A note on the project cost as well. It's important to recognize that the capital cost that you get from your engineering team is one component of it, and the project cost is then has to include owner's costs, financing costs, and contingency, which can add 20 to 30% sometimes or more, depending on how the project rolls out, to what the capital cost is for the equipment and construction. So a little bit about different strategies. There are a number of sources of funds available. Some groups that have the balance sheet are able to execute projects internally. This gives obviously a lot more flexibility to how projects are executed. Most of the time, larger projects are financed in some fashion through some type of debt. Typically, or in some cases, if the sponsor doesn't have a strong balance sheet, then the project should be structured for non-recourse debt, and we'll talk a little bit more about that on the next slide. Leasing is another alternative that has gained some popularity, but this also requires equity and debt prior to converting it into a lease at the end of the construction period. And we'll talk a little bit about government incentives as well, because there are a number of those out there in play right now. Risk is, okay, so here's a typical, although there's not really a typical model, we wanted to put something up that may be representative of what, say, a $100 million project would be balanced to. So there'll be equity from the original investor, the owner, or the sponsor. And the trick there is to put together a solid business plan, attract that initial investment. The banks or lender for the debt will typically come in. You can structure these projects for non-recourse debt. And what that means, we'll talk about it a little bit more on the next slide. And then the incentives, we'll just mention that your project should stand on its own and should be economically viable without leaning on incentives. And obviously, you want to take advantage of as many of those as you can, and that's something that you can typically hire consultants and experts such as those enterprises to help fill out that paperwork. That's typically a fairly sophisticated process and fairly time-consuming. All right, so non-recourse debt is something that the banks look at a project very closely because they have no recourse. What that means is they have no recourse other than to the performance of the project and the cash flows of the project. So when they're doing an evaluation, they need to be very confident that the contracts, the strategies, the project execution plan is set up well, and in the event that the sponsor is not able to perform, their recourse is to step in and take the project over. The investors, and here we're talking about the equity component of it, typically are larger institutions. They are also obviously very concerned about the risk and return, and they're interested in having an exit strategy and seeing solid returns on their investment. So those two groups are very aligned in ensuring that the project goes well. So as you put your project together for financing, it's important that you focus on minimizing the risk and presenting a viable project plan. So let's talk a little bit more about risk, because when you're talking to lenders, that's their most key issue, is understanding the risks and understanding what the sponsor and the project intends to do to mitigate those risks. The basics are always where a person should start out, have a good story, understand and present the value proposition well. And it's important as you go through the process that the banking lending group you develop a good relationship with them, and they understand who else is investing. This is one way of representing the key aspects of a bankable business plan. We break things down here into 11 different pedestals. Each of these are quite important, and all of them need to be dealt with in detail. The big ones, though, are the feedstock agreement, the offtake agreement, and then everything else. How are you going to get the project done? Okay, so a couple of key risks. These are some of the questions that will come up as you go through that need to be answered. Sponsor, really the credibility of the sponsorship company or team. What's the expertise? What's the reputation? And what has been done previously? And if the sponsor doesn't have a strong record, it's often a good idea to align yourself with a team that does have that expertise, that you can demonstrate credibility to the lending group before you pursue financing. Feedstock supply is absolutely critical for any biomass project. It's quite difficult sometimes unless the owner or the sponsor has access to that feedstock or is affiliated with a sawmill or someone like that has access to the forest land base. If you are going out and trying to secure long-term feedstock contracts, they need to be with someone who has credibility to the lenders, and it needs to consider such long-term things as the price of fuel and government regulations and some other issues that are difficult sometimes to nail down over the longer term. The offtake agreement is another key aspect of it. It's important that you have a viable long-term price for your electricity product as well as any other products that are being produced. If it's a cogeneration facility that's selling heat, or if there's char or ash that are of value, that you need to have agreements to take those away. And they need to align, all of these contracts need to align for the term of your project for the financing. Site is also quite critical. Infrastructure costs. You're developing a greenfield site, a lot less complexity than taking a brownfield site, but then there's also permitting and other infrastructure requirements that need to be considered. You want to be able to get good access and deal with public opinion around having a biomass project there. Lots can be done with emissions to minimize those, but a lot of times people will see a condensate from a cooling tower or from a stack of a boiler, and they don't like seeing stacks in their neighborhood. Then the technical feasibility. There's, regardless of how well you think your plan has been put together, it's vital that you have something that stands up to third-party review. There'll be independent engineers involved from the lenders. It's important that you do a good quality engineering study up front and get everything nailed down, because when you go for financing, everything needs to be locked and set in stone at that point. The bank will be very critical of all the work that's done, and they want to see it within the constraints of industry norms. If you have a project that looks significantly less expensive than others that are being done, there'll be a lot of questions about why that is. The bank's not necessarily interested on the lowest capital cost. They want confidence that the project will go well. So what's the takeaway? Pay attention to all the details and make sure that you are able to understand the risks and communicate strategies to deal with them. Important for the lenders, but also critically important for the sponsor, because you never want to get tripped up on things that you could have taken steps to avoid ahead of time. And there are a couple of examples recently that many examples of failures in biomass. Here's a couple recent. One where a very good quality project was built that had a solid offtake agreement with a strong utility, but unfortunately the pricing was a market price and they weren't able to maintain an adequate revenue stream. That's a 50 megawatt plant in Texas. And another one recently that was done at Oak Ridge that's offline due to problems with feedstock and the corrosion with the material that the equipment was fabricated from. So every little detail is important. Just a real quick bit on government incentives and other credits. There are a number of these that are available right now as part of our various global commitment to carbon reduction and clean power. And as well, in Canada particularly, there's a strong opportunity with First Nations that have access a lot of times to either fiber fuel or to utility for power purchase agreements. So again, it's important that your project utilizes and accesses all the incentives that are out there, but your business case should stand strong even if you aren't able to access an example of a accelerated depreciation in Canada. The stuff in the box is available to write off more quickly than other parts of the plant, and this is often attractive to a large corporation. And there's been some good success with bringing those pension funds as well as life insurance companies in as an equity or as an equity and debt partner, because they're able to take advantage of those tax write-offs. So there's our coordinates, and I thank you very much for your attention, and I'll turn that back over to you, Jeff.
All right, thanks, Tim. Next, we're going to have David Edwards. David is also part of the Lee Enterprises Network Partnership, and he is a pilot plant and design professional. And here's to talk more on the pilot plants and the designs and how that fits into the strategy. So, David, I turn it back over to you now.
All right, thank you very much, Jeff. So my presentation today is entitled Commercial Considerations in Pilot Plant Projects. My name is David Edwards. I'm Vice President of Sales and Marketing at Zeton. I've been with Zeton approximately 21 years. Just a quick message about Zeton. We are a specialist in the design and fabrication of pilot plants and demonstration plants. So we both design and build. We have 2 locations, one in Burlington, Ontario, where I'm located, and one in Enschede, the Netherlands. And our playground is the world between the 2 divisions. So the first question that we often get asked from a business person is, why do I need a pilot plant? So this comes back to the purpose of a pilot plant. Pilot and demonstration plants are used to de-risk technology scale-up between laboratory and commercial scale. So there's a couple of things I want to pick up there. One is there are 2 scales we're talking about, pilot and demonstration. And then the second is the de-risking of technology as you scale up. So the first slide really discusses the scale-up from lab to pilot to demonstration to commercial. Most of the early work on a new process will be done at the lab scale, and this would then go through a pilot phase where you would kind of look at those results from the lab scale and make sure that they make sense. And then if they do at a pilot scale, you may go straight to commercial. But oftentimes for bioenergy and biofuel projects, there is an intermediate demonstration project before you would go to commercial. So a typical order of magnitude for a pilot plant in terms of cost would be $500,000 to $5 million. And the demonstration plant cost starts there and goes up to about 20 million. And then it's often tens or hundreds of millions for a commercial plant, depending on the size. In terms of risk, this slide gives the best representation of process development and scale-up risk I've ever seen. I wish I could claim authorship for this one, but I can't. As you go from lab to pilot and pilot to demo and demo to commercial, the risks increase because the size of the equipment increases, the capital cost of the plant increases, the amount of product that's produced increases. So the valley gets deeper and gets harder to cross. And while a lot of projects go from lab to pilot and pilot to demo, going from demo to commercial really is the key for any technology, and is the hardest step in terms of financing the project, in terms of proving the technology out at that scale, in terms of continuing the project. However, if you are successful in that and you do go through that step, then this is the kind of plant you will look at the end. It's a commercial scale production plant. It's a small plant, so it's distributed manufacturing. It's 5 tons per hour of biomass feed, delivering 84 tons per day of pyrolysis oil or biocrude. And this project was designed and built by our sister company in the Netherlands with substantial funding from the EU government. So what types of financing and capital do we see on pilot plant projects? I would say the most we see is retained earnings from Fortune 500 customers that we have, retained earnings. Secondly, for startups, it's private equity, angel investors, and venture capital funding. The fourth type of funding is government loans and grants, as was the case for the previous project that I showed. That's quite common for pilot plant projects and demonstration projects. Then we see bank loans and debt financing. Sometimes we see employee stock purchases. Occasionally we see in-kind contributions of various kinds. And then all the other types of financing I'm going to lump under the word other, because there are probably other ones there that I'm not covering. So when you want to finance a pilot or demonstration project, the next question will be, well, how much are we looking for? And so this slide really covers the way that a progressive cost estimate is generated. So an initial estimate is generated at the class 5 plus or minus 50% level. It's based on previous projects that are typically like the project that is being considered by the customer. And based on that and some simple calculations, we come out with an order of magnitude concept kind of guess at the class 5 level. If that guess is reasonable, and the next step will be to conduct preliminary engineering, where we produce a class 4 plus or minus 30% cost estimate. So there's some effort involved here now. That would be paid effort. And then if that is successful and we want to continue on, And the next step would be basic engineering, leading to a Class 3 plus or minus 10% estimate. That is essentially lump sum fixed price for the plant itself, and it kind of ends the progressive cost estimation phase of the project. So how that fits into the overall project is phase one. All those three steps kind of fall into phase one, which is cost estimation, basic and preliminary engineering. That is completed on a reimbursable cost basis and is typically 3 to 6% of the project cost. If the project gets approved at that point and you go through to actually building the plant, then phase two is detailed design, procurement, fabrication, and factory testing. This is the bulk of the project. It's 90 to 96% of the value of the project, and it's completed on a lump sum fixed price basis. And then subsequent to that may take anywhere between 6 months to a year, or sometimes even longer for very large projects. And then phase three is we ship the plant, we help our customer to install it and start it up. And that reimbursable cost basis is roughly 1 to 4% of the project for Zeton. So how are these projects organized? The customer obviously is in the driving seat. They're funding the project. And then there are two parallel paths in terms of organization. The first concerns the ISBL scope, which is the inside battery limit scope. This is the part that Zeton manages, and we manage the vendors to design and build the plant, the actual physical plant itself. The second parallel part is the OSBL scope, which is the outside battery limit scope, and is the on-site scope, which is managed by a local EPC close to the location where the plant will be located, and the local EPC will manage the site contractors to erect the plant and to handle the infrastructure at site. So I've listed 4 benefits of a modular design build methodology. The first one, it's an innovative, integrated, customer-centric approach to delivering modular pilot plant projects. For pilot plant and demonstration plant projects, modular fabrication really lends itself to these projects because they are relatively small compared to large production types projects. And the second benefit would be for the plant itself, you have one contract with a single point of responsibility for both the design and the fabrication of the plant. That's the benefit of design build. The third benefit is a lower capital cost and an accelerated project schedule, because that's what modular fabrication delivers compared to site construction. And the final benefit I've listed is superior craftsmanship in a controlled shop setting. So this is a commercial decision early on to go either at a modular design build or to go stick built on site. And the modular design build does offer significant benefits. I want to highlight the third point, the schedule improvement, in my next slide. A traditional EPC approach really handles most activities in series, one after the other, consecutively, whereas a modular design build approach handles the activities concurrently or co-currently and in a parallel fashion. So you can see that design engineering, detailed engineering, and procurement are overlapped, as is skid fabrication, as is control system fabrication. So on a typical 13-month project, you might shave 3 months off that schedule to get down to 10 months. And this is quite common for modular design build. So my final slide, last year I published a paper on scaling up bioenergy processes and technologies. And if anybody is interested in this paper, I'd be more than happy to send them a copy. Thank you very much.
All right, thank you, David. The last presenter we have is Jim Rathall, attorney with Sullivan & Worcester out of Washington, D.C. He works with clients on the project development and financing for energy projects. And with that, I'd like to turn it over to Jim.
Thanks, Jeff. Yes, this is Jim Rathall. I'm with Sullivan & Worcester. We're based in Washington, D.C., although our firm has offices in Boston, New York, London, and also a joint venture in Tel Aviv, Israel. We're pleased to be here today. Thank you, Wayne, for involving us. We've enjoyed our work with Wayne and the group. Our focus here in our energy finance practice is really on the early stage development and sort of innovative side of energy transactions. We work with a lot of companies across the solar, wind, and also biomass and biofuel sectors. And we really look at, from the legal perspective, the challenge of adding value, of facilitating transactions, of addressing the legal issues, and getting the incentives to bear in a way that works commercially, develops and supports the investment. And we really work hard to be sort of a value add in the process, and I can talk more about that. So a number of the issues that I'm going to address are somewhat duplicative from what David and Tim were speaking to, except we're going to talk about sort of the legal perspective. We have had a fair number of recent projects and deals in the biomass sector, so we have some specific recent experience. We are representing now a major hedge fund with over $20 billion in capital that has a specific subsidiary that's developing biomass projects. We've done several of them, and there are others in the wings. Using innovative anaerobic digester technologies and going at the project from a development stage to putting in equity and then debt financing. So I think we have a pretty good perspective on the sort of full sweep of issues that arise in those contexts. On biofuels, we also have significant experience. It's more on the regulatory side. We've dealt with a lot of the issues relating to RINs, and we have advised some startups on financing, but not quite to the volume that we're seeing in the biomass space. So topics for discussion from the legal perspective. Where are the value streams coming from? A lot of this is as Tim mentioned, policy-driven. You've got a lot of incentives, both tax credits and renewable energy programs and carbon-related programs. So a lot of that comes into play on the legal side. What are the risks? As you work through the transactions, as Tim really mentioned, a lot of the work from the investor and the finance perspective is in addressing the risks, identifying them, and then handling them in the transaction documents. We're very involved there. And then really just the sort of nuts and bolts of structuring and documenting and how to get that done right and efficiently. So that's really kind of where we're coming from. I'm not going to go too far into the details. A lot of this is high level as we cut through these slides. But for anybody that has questions, you can ask them now, or please feel free to circle back. I mean, one of the things we like to do in working with early stage companies is we're happy to get involved on the front end, just in talking without necessarily getting on the clock. So we're always willing to hear about a challenge or a project or help look for financing using our contact network. So through Wayne or otherwise, please feel free to reach out. I have an overview slide. I think this has been fairly covered, so I won't go too far into the details. I guess the one thing I would say is that biomass projects we're seeing generate an increasing share. I think it's fair to say that they're on the upswing in terms of their role in the overall energy and renewable energy mix. And in particular, some of the technologies are really coming along in terms of their performance and efficiency. Both traditional biomass and biomass CHP that we're seeing in the market now. The economics are really compelling when you bring these technologies on, and then you layer over the incentives, and which is why I think we're seeing so much activity. So this slide talks about the legal perspective and considerations. A number of them have been addressed. I won't go through them all again. I think you can see the slide. I would concur with Tim. The more you can get these issues on the table early, plan around them, analyze them, get them squared away, and have them ready, for investor appetite and sort of professionally dealt with, the better. There's a lot of complexity to these things. And getting them right in the first place can make a big difference. In the United States, you look at the regulatory backdrop and where some of these value streams are coming from. I think most people on the call are probably familiar with the RFS program, the Renewable Fuel Standard. and also RPS and states, the Renewable Portfolio Standards that biomass projects are often eligible for, that generate RECs that have their own value streams. There are also lots of federal and state incentives for brownfields redevelopment, and even at the local level. We often see these projects being developed at locations that have been previously used as industrial sites, and you want to make sure and look for those kind of programs and what's available in terms of additional economic support. And then finally, now we're seeing EPA's Clean Power Plan being implemented, subject to a lot of the litigation that's going on. But notwithstanding that, the states are moving forward, and EPA has recognized biomass can play an important role in that Clean Power Plan implementation, and I think we're going to be seeing that as a major driver, although we do need to be careful that we're considering the different feedstocks and that they're adequately being classified in order to be eligible for the benefits under the state programs where the CPP is being implemented. Then on the tax incentive side, where a lot of the value comes from, we were obviously all very pleased to see the tax incentives extended in December. There was a lot of question about whether that was going to happen. It was good to see a deal actually work here in Washington. I think there really was a fair amount of resignation. And for biomass in particular, the production tax credit is available, and you can get into the details there. Happy to circle back on that. You can also elect an investment tax credit, a one-time 30% ITC. And then there's a bonus depreciation, which can be built into the financing and economics of the project. Those were now extended for projects at this point through December 31, 2016. So we've got another year to commence construction. There were also extenders in the tax bill in December for the $1 per gallon blenders tax credit for biodiesel. And also second-generation biofuel production credits got extended through 2016 as well. So across the board, we have more time to work with tax incentives and build those into projects that are ongoing. Financing sources and structuring. Typically, you start, and Tim did a good job going through the different tranches, but at the early stages of these projects, you're not going to get sort of a big bank loan. You're going to start with VCs and hedge funds and private sources of capital for the equity piece, and then you can layer on debt through special syndicates or otherwise specializing sources of debt finance. Project finance is absolutely typical for these things, and that's the model that we see where you're going to have to really get into the project-related risks and fully address them in the transaction structure. We also see specific government incentives and DoD, Department of Defense programs that can be available really more in the form of grant funding for some types of technologies and projects. So that's another place where you can look for financing as well. And in any given context, if you've got a particular project you're working on developing, then please feel free to check in with us and we can talk more about some of these specific sources. They tend to have their own very narrow constraints and financial models that they're working with and looking for. And so you want to really make sure your project is designed and documented to hit the financing parameters of the slice that you're looking for, basically. Here's a slide with just some of the challenges that can come up. Tim hit a number of them. You've got your ability to make sure you qualify for some of the regulatory upsides and requirements. Technology risks are always big in this space, and making sure that you've got your engineer report. Regulatory and permitting. I've got another slide coming up on due diligence that we can talk about this in a little bit more detail. here what we're seeing in renewable energy generally and in biomass as well, innovation in financing approaches and in sort of types of frameworks that bring more of a portfolio model to bear on building projects and then financing them upstream. A number of these things are more popular at this point for solar and wind, but I think that biomass is going to start seeing more activity in these kind of innovative financing structures. And now we get to some of the key legal due diligence categories. Here, as we represent investors, for example, the big hedge funds, we've got very detailed questionnaires and analysis that we do, some of it with expert engineers and other experts. We need to understand the financial model in absolute detail. What are all the cost centers are, where are the revenue streams, and what are the risks associated with those, and how it all plays out to deliver the IRR, which of course is the magic number that we're looking for. You've got timelines, construction issues, EPC contracting that are all thoroughly reviewed. And then you're looking at offtake with your power purchase agreement. Is it with a utility? Is it with a private offtaker? What's the term? What are the details of the offtake agreement, the PPA, to make sure that risks are adequately understood and addressed there? Feedstock, as Tim said, critically important. You've got to know there's long-term supply. You need to know the pricing. You need to know the risks on that front. And then when you get past sort of the base economic performance expected of the project, you get to some more traditional legal due diligence like environmental. What kind of site is this? As I mentioned, a lot of these are on industrial properties. Well, those have environmental histories, and we carefully review them. We've certainly seen issues arise, and you've got to make sure that those are fully understood as you're taking over a site for 20 years or more. There's a lot of permitting issues when you have air and water emissions, which are typical. When you have waste coming in as a feedstock, that's a regulatory permitting issue. You have waste streams going out, same thing. Real estate, you've always got to deal with site issues, whether it's lease or ownership. And zoning, these kind of projects can obviously attract community attention and potential opposition, and you need to make sure that all that is detailed and thought through in advance so that you're not at risk of any adverse problem there, and all the paperwork is in place for the closing. And then sort of transportation issues also are key when you're bringing large feedstock supply into a plant like this, so you need to have thought through that as well. EPC contractors can make the difference. We work with some big firms that have done lots of these projects around the world. Your contract and making sure that that's done well and address all of the provisions is a key question from the investor's standpoint. This is where we get into a fair amount of this sort of negotiation around risks, and good EPCs will take on much, if not all of these kind of risks in connection with the contract. You look at protecting the cash flow where there's technology risks. You occasionally get into parent guarantees. Sometimes we work with foreign EPCs that have U.S. subsidiaries, and we always look for a parent guarantee. You have liquidated damages to say that if things go wrong, the EPC will cover for the cash flow that was expected as a result of delay or performance problems. Insurance is an area that we are increasingly seeing in these kind of contracts, and sort of specialized insurance products that are designed to address specific types of risks and really can close off and tighten up these projects in a way that's meaningful from the insurance from the investor perspective rather. So that's becoming very important. And then finally, we always deal with the issue of indemnification and liability. If things really go wrong, those are heavily negotiated provisions. Finally, I just threw in, timeline is always important. How long is this going to take while people are spending money on transaction costs? this is kind of just an example of a timeline that can apply. We see our job as largely to keep things moving and make sure things done are efficiently, that we've got good sort of Gantt charts of what's going to be required from the legal end that match up with the construction and financing schedules, and that it all gets done well and on time. So I think that's pretty much covers the legal perspective, and again, happy to take any questions either here or offline. Thanks. Back to Jeff.
All right, thanks, Jim. As we go here into the summary slides, and I'm to wrap up, if you have any questions, feel free to write them out on the screen, and we can address them and go from there. As we noticed in technology, sometimes when you email things around, they don't always show up perfectly, and I have a couple slides that are off a little bit. With this wrap-up, some of the successful things that I have seen in getting to financial close, both as a banker and in this project development type role, is what everybody has touched on. And I thought I would just highlight in 3 slides things or some notes that you can just write down and make sure your plan or your pitch is ready for it. And first is your debt and equity allocation. It's the total project cost. And as we've talked about, well, how much equity do you need? How much debt do you need? Is it sub-debt? Is it senior debt? You need to make sure you know exactly your total project cost. And that is the total cost of the plant, property, and equipment. Then also go ahead and add to that all your pre-production, organizational, general operating funds through the end of ramp-up, construction, or your stabilized growth period. And then finally, what is that beginning working capital? And what does that mean? It's the cash to cover your outflows of funds so you don't overdraw the bank. And you really don't want your banker mad at you. And in summary, what does this mean? Well, it's the owner scope plus the contractor scope with contingency. As we talked about risk, I have identified 6 areas that every presentation that I do, either when I was a banker I looked at, or as on this side of the desk where I'm helping raise the capital structure for a project, is technology and construction. You know, I was on a phone call here over the last month, and they were talking about they had no technology risk, and I said, well, where can I go see your technology at? Because if we're going to do this, we got to be able to kick the tires. Well, that's what we want to build. Well, you have technology risk if you don't have it up and operating someplace. And so technology and construction, it goes back to the EPC and making sure you're working with Jim, and we've got all of the foundations covered. You don't need a litigation case trying to collect on performance because it never performed right. You have to assess your operational and production risk. Even after the time period of warranties are over, do you have the right staff that can run the plant? Number 3 is your markets, but really it's focusing on the commodity or your feedstock and where you're selling your product to. Management. A lot of your equity providers want to look at management and what is the strength of management. And my favorite saying there, just because we think it doesn't mean we can manage it. And do you have the management team that has the proper background? The last 2 on this slide is government policy and currency. You always have to plan and be prepared for government policy changes and what your currency risk or currency rate will be, because those 2 things are out of our control most of the time. And as we're seeing it now with the renewable fuel standard, what will happen and where will it shake out at? The final summary slide is really the pitch. What is the pitch book? Well, I believe you take everything that was discussed today in the 3 presentations and you build it into 7 sections. The executive summary, the transaction overview, your business plan of operations, the management and the team of the company, your historical performances, or your economic forecasts, and substantiate that and how do you support it, because we know forecasts aren't always become true. What is your company timeline, and be realistic. If you're an early stage company, be realistic and add some time into it. If you rush it, and you try to rush it, you will probably fail. And then what are the transaction merits? Now, the two things I highlighted on the right side of the slide is really tied to the executive summary and your transaction overview. And the other 3 through 7, I can spend 3 to 4 hours discussing these points and what we do, how we do it, where we do it. But for the executive summary and the transaction overview, it needs to be easy to read, high level, and give us a good overview, concise overview. And what happens is practice your pitch. In this executive summary, when you're talking to somebody, make sure that you're very precise and you're not confusing people. Back in November, I had a phone call. They said they had 100% debt. Okay, why are you calling me? Well, they really didn't, because they were still trying to build out some technology and test it, so they needed money to be raised, but they thought telling the story they had the debt would make it easier, and it actually confused it. The transaction overview describes your request and your structure, and that, again, has to be very clear. If you're trying to go out and raise money, you need to know what you're really wanting to do and be willing to tweak it and modify it with the capital providers, with either the lender or the equity provider, because they all have structures they like and they prefer, and you want to be successful. You know, I've read reports where 7 out of 10 fail, and you want to be one of the 3. And I know from our standpoint here at Lee Enterprises and what I do, I'm very selective because I want to be with the winners. I don't want to be on the tail, on the behind side of the 7 that don't make it, because those are not fun. So with that, I'm going to go back into the questions and answers of those coming in, but I'm going to tee it off with this one question for the 3, and I'll let you guys choose what you want to do. What are 2 or 3 items that you believe have been successful or consistently successful in getting to financial close? Anybody want to take that one?
Well, it's Jim here. I mean, I think everybody could. I can kick it off. Getting to successful close, from my perspective, is all about what happened in the earlier stages and how well that was done. I mean, my clients tend to come to these projects at a point where they've been developed, you know, through early stages, and the more careful and better the work was, both technically and in putting the project together, and also in documenting it. You know, the early stages of site control and permitting and feedstock and contracting, you know, all that being done really well and in a data room and available. That's what really tends to get the process done more quickly and less expensively, in my experience.
Okay.
It's Tim.
David, you want to?
Absolutely. Yeah, sorry to cut in there. It's Tim. I can definitely add a second item, and that is to make sure that as you are putting all of these documents together, it's a tremendous amount of work. It's very important that it's done in a way that it meets the requirements of the lenders, and that perspective is different than the technical perspective or the owner's perspective. And if you haven't been down that path before, it can be quite frustrating and confusing, and so that's where it's really important to bring in folks that have done it before, because if you present it properly and make it easy for the lenders to say yes, it allows that whole process to go much more smoothly.
All right. David, do you want to say anything? If not, I think we probably have time to answer maybe one more question. We have a few coming in, and we can respond privately too with those. But David, do you want to say anything?
No, I think, Jim, go on to the next question. It'll be fine. So. All
right. On this question, it was asked about biochar and any interest in that COP21. Jim, you want to take that, I see?
Sure. Yeah. So the question was with COP21 and the climate conference in Paris and agreement. How could that play through on bioplant development? I think there is a push there, and what we're seeing from Washington in particular is in developing countries. A lot of the climate finance and the multinational agencies like the World Bank are really looking to push in order to help comply with the climate agreement to put money into places where these kind of projects can be developed. So we do work with those agencies. We see a lot of that. In particular, the Obama administration has a plan called Power Africa, and I think there's a lot more sort of financing available as a result of the climate and multinational bank pushes than there had been even a few years ago.
Okay. Well, with that, I am going to push this back over to Wayne and to Lee Enterprises, but if you want to reach out to any of us, go ahead and contact Ashley. Her contact information there is up on the screen now, and she does an excellent job in fielding, talking, and circulating any questions or anything that you can have of Lee Enterprises. So with that, Wayne, I'm turning it back over to you.
All right. Thank you, Jeff. Again, this is Wayne Lee, CEO of Lee Enterprises, and I want to thank our two engineers, Tim Hoy and David Edwards, are two of our engineers that spoke today. I want to thank you, Jeff, our financial guru, and I want to thank one of our lawyers who spoke today, Jim Rathall, for their participation in today's conference. At Lee Enterprises, we deal with the traditional biodiesel and ethanol projects, and we also deal with all of the emerging technology and biomass energy type projects. So we really have a fairly large scope of what we do and the members of our team. If any of you all think of questions or you need guidance on any projects, please feel free to contact any of our speakers. You can contact them directly through Ashley. Her email is listed here. You can always call us at our phone number, 501-835-8511. If you want to see a full list of all of our consultants, all of our strategic alliances, I invite you to visit our website at www.lee-enterprises.com. It should be at the bottom of all of your slides. That'll show you a pretty good analysis of most of our consultants and strategic partners across the world. We have lots of PhDs and academians from several top institutions around the world. We've got lots of engineers, construction groups, a number of accountants, attorneys, insurance groups, and that kind of thing. So we can help you with pretty much anything you're doing. One final note for everybody, this webinar will be downloaded and made available to each of you next week. Ashley will get that out to you. And I think with that, we should be at about an hour. So with that, that'll wrap it up for now, and we look forward to hearing from you. Thanks for attending, and goodbye for now.